Your financial advisor's fee looks like 2%. It isn't. Over 20 years on a $100,000 portfolio, that 2% quietly pulls something like $160,000 out of your retirement. Here's the part nobody explains at the sign-up meeting. The damage isn't the 2% they skim off the top. It's every dollar that 2% would have grown into if it had just stayed in your account, compounding for you. This whole reframe comes from J.L. Collins, the guy whose stock series basically rewired how I think about investing. And the number is what got me. Run the same $100,000 through 2 doors. Door 1. You invest it for 20 years, averaging 8% a year, compounding monthly the way an actual brokerage account handles it, not once a year on some tidy anniversary date. Hands off. You end up with $492,680. Door 2. Identical money, identical 20 years, same monthly compounding, except now 2% a year goes to a manager. Your return drops from 8% to 6%. You end up with about $331,000. That's $161,660 gone. Same starting money, same market, same 2 decades, same monthly compounding. The only difference is a fee that sounded like a rounding error at the sign-up meeting. That gap is so much bigger than the sticker suggests, and the reason isn't complicated. In year 1, 2% of $100,000 is $2,000. That feels survivable. But that $2,000 doesn't disappear just once. It disappears every year, and it takes with it every dollar it would have earned if you'd left it alone. By year 20, you're not missing 1 year's fee. You're missing 2 decades of growth stacked on top of every fee before it. A number on a disclosure form never shows you that part. Here's the reframe, and it's really the whole video. You didn't lose 2%. You lost 2% and every dollar that 2% would have earned, and every dollar those dollars would have earned for 20 straight years. Fees compound against you the exact same way returns compound for you. That 2% usually gets billed as AUM, Assets Under Management. It just means the total pile they're managing gets a slice skimmed off the top. That happens every single year, no matter what the market did that year. A typical advisor charges 1 to 2% of assets under management annually. That's the going rate across the entire industry, not some rare bad apple. It sounds small enough to shrug off. It is not small enough to shrug off. When I first saw 2% on a fee sheet, I remember thinking, that's basically nothing. That's less than what my cell phone bill eats out of my paycheck. 2% of a giant number is still a giant number. I just hadn't done that math yet. So, if it's costing that much, why does nobody feel it? Because you never actually see it leave. You never write a check for this fee. That's the trick. It gets skimmed straight off the top of the account once a quarter, quietly. The market's usually up, your balance looks bigger than it did last year, so it feels fine. Your quarterly statement shows a line item so small it blends into the fine print. Nobody's hiding it from you on purpose. It's just built to be easy to miss. I've squinted at grocery store receipts closer than I've ever squinted at that line. A 2% AUM fee is basically a subscription to your own money, one that renews automatically forever and quietly gets bigger every year your balance grows. I know what it's like to hand your money to someone else and stop really watching what happens to it. A few years back, I put some crypto into a yield-bearing savings account, the kind that loans your coins out to generate a return. I was at my desk one night, phone in my hand, just checking the app like I did most nights. Then, the withdrawal button didn't do anything. I remember thinking, wait, why can't I withdraw? I refreshed it 3 times, my grip tightening on the phone each time, like that was going to change the answer. The platform had over-leveraged, gone bankrupt, and the money was just gone. Your advisor isn't running out of money and vanishing with yours the way that platform did. That's not the risk here, and I'm not claiming it is. This is quieter, a fully legal, fully disclosed 2% fee that just points their incentives away from yours on the decisions that matter most. No fraud required, no bankruptcy, nothing dramatic enough to make you check the app at midnight, which is exactly what makes it so easy to miss. The moment your money sits in someone else's hands and they get paid a percentage of it, that's the moment your incentives and theirs stop lining up. You've handed over control of the one thing J.L. Collins says you should never hand over. And there's a way to never hand that control over in the first place. I'll show you exactly what it looks like in a few minutes. I'm not here to tell you your advisor is a crook. Most of them are decent people who got into this because they like helping people with money. The problem isn't the person, it's the structure. Their interest and your interest point in opposite directions on the exact decisions that matter most. Picture this. You've got a $100,000 mortgage and $100,000 sitting in an account your advisor manages. You ask them, should I pay off the house or fund my kids' college so they don't start life in debt? Both of those could be great moves for you, but both mean pulling that $100,000 out of the advisor's account, which erases $1,000 to $2,000 a year in fees they collect on it. Every year, forever. Whose retirement is that advice actually protecting? There's a quieter cost stacked on top of the fee, too. The vast majority of paid managers underperform the plain market. Something like 8 or 9 out of every 10 over the long run, according to the industry's own Spiva scorecard. That number surprised me the first time I actually saw it broken down. It's not that these managers are bad at their jobs. It's that beating the entire market year after year is a hard game for anyone to keep winning. And you won't know if you got one of the rare good ones for about 20 years, by which point the fees are already spent. Even the genuinely good ones have to out-earn their own fee before they've helped you at all. That's a headwind most people never realize they're running against. That 2% AUM fee is just the most common costume this problem wears. Annuities and whole life insurance can bury commissions as high as 10% inside the product, so you never even see them leave. Hourly advisors charge $200 to $300 an hour or more for that same access to your decisions. At least there, you get an invoice, which is more than my doctor's office gives me half the time. Different sticker, same math. Money paid out today is money that stops compounding for you today. I told you there's a way around all of this. Here it is. For years, I didn't invest at all. I remember sitting at my kitchen table with a brokerage app open on my laptop, just staring at the screen, not touching anything. My cursor's sitting there, blinking over a search bar I never typed into. Not because I was lazy, because I thought I only had two options. Option 1, pick stocks myself, which felt like gambling with money I couldn't afford to lose. Option 2, hand it to a financial advisor, which felt expensive, intimidating, and honestly, a little like admitting I couldn't do this myself. I remember thinking, said it out loud actually, to an empty kitchen, there has to be something in between. There wasn't, or at least nobody showed me one. So I closed the laptop. Both doors felt shut. I did nothing. For years. I've made faster decisions ordering lunch. What I didn't understand back then is that both of my options were the same mistake wearing different clothes. Picking stocks means betting you're smarter than the market. Paying an advisor 2% means betting someone else is smarter than the market, and paying them whether they are or not. Neither one is really about investing. Both are about outsourcing a decision I hadn't learned I didn't need to make. There was a third door the whole time, and nobody pointed at it. You don't pick stocks, and you don't pay someone 2% to pick them for you either. You buy the entire market in one low-cost index fund, and you leave it alone. It's simpler than picking a good advisor, cheaper by a mile, and it still beats most of the paid pros. Nobody told me this back at that kitchen table. A total stock market index fund doesn't charge 2%. It charges a few hundredths of 1%, the kind of fee you'd need a magnifying glass to find. You're not trading a 2% advisor for a smaller one. You're trading it for something so close to free, it barely shows up in the math at all. And you don't need to get clever about which fund either. One low-cost total market index fund, not 10 funds, not some mix of sectors you've decided will outperform. One fund that owns a slice of every public company in the country. You add to it on a schedule and otherwise leave it completely alone. That's the entire strategy. It sounds too simple to actually work, which is exactly what kept me out of the market for years. Here's the trade-off nobody names out loud. Spend years trying to find that one rare, actually good advisor, interviewing people, decoding fee structures built to be hard to decode, waiting years to find out if you picked right. Or spend an afternoon opening an account and automating this instead. One of those paths keeps the $160,000. The other hands it away for the feeling of having a professional in the room. Nobody will ever care about your money more than you do. That's not a motivational poster line. It's the entire math of this video. The fee is what you pay to outsource the caring, and the fee is enormous. J.O. Collins built his whole philosophy around never giving up that control. The $160,000 was never really at risk from a bad year in the market. It was at risk from handing away the one thing that was always yours to keep: attention. So you skip the advisor and keep your $160,000. Then you put it into a low-cost index fund at a big fund company. Problem solved, right? There's a catch. Most fund companies answer to two masters, you and outside owners who profit when your fees go up. There's one company on earth where the investors are the owners. Which one and why it changes everything? That's next. You just clawed back $160,000 from an advisor's fee. Don't hand it right back to a fund company with that same conflict built in. It's already on your screen. Click it and I'll show you which one and why it's different.